Investors are welcoming softer than expected inflation data out of the U.S. The September Consumer Price Index was finally released after it was delayed because of the government shutdown there, giving markets a lift. Let's get some perspective now from Gwinn, head of U.S. rate strategy at RBC Capital Markets. Blake, thanks very much for joining us.
Thanks for having me.
Numbers pretty much in line with what everybody was expecting?
Yeah, I was going to say, it might have come in a bit softer than expectation, but I think if you actually look at some of the details, the big drop was really the owner's equivalent of rent. So really the shelter kind of component was driving most of that miss. A lot of the other stuff that we focus more on, so really like the services side of things, and even goods, not exactly great numbers, still showing some pressure that I think from the Fed's perspective, have to be a little bit problematic. Just because the headline's coming down because of owner's equivalent rent, I don't think the Fed can kind of sit back and say, okay, great, inflation's not a problem.
What were some of the numbers that were worrisome to you?
That services ex shelter, so the super core that we often hear, Powell mentioned in the past, that we know the Fed kind of focuses on. That was off a little bit relative to last month, but it's still very elevated. If you look back over the last year and a half, 2 years, still on the higher end of that. So really no kind of help there. Like I said, a little bit of a pullback, but really still at elevated levels. Lastly, the good side, not something I think is necessarily problematic, but we're starting to see that tick up, probably a bit more of that kind of tariff pass-through that we're starting to see there. I would say at a higher level, that services piece in particular is a little bit worrisome because I think a lot of the theory around the tariffs and the reason I think people were a bit more sanguine on the tariff inflation is that you kind of accepted that goods prices were going to be reflecting some of those tariffs, but that a continued downtrend in services was going to offset that tariff-related goods pressure. And if services are also moving higher at the same time as we're starting to see that pass-through from tariffs, on the good side, not really a great combination.
It sounds a little more concerning. Were there any positive signs to you in there? Any sectors that maybe let you think that maybe we might see inflation dropping a little bit?
No, not really. And I mean, particularly I mentioned that OER, that was the big miss. That looked a little bit odd. I mean, that was one of the biggest month-over-month declines we've seen in that OER component in history. It was even bigger than, if you look back at the housing crisis, like GFC, it's actually bigger. So I can't imagine that continues. That's not something that we can expect to sustain into coming months. So yes, it was better than expected. It came down more than expected, and it pulled down those headline numbers and gave us, what looked on surface like a softer print. But I don't think we can expect that to continue into future prints.
Now, with all that you're seeing there, the talk has been that we're going to see a Fed rate cut in the States next week. Can you see them continuing with that?
So, yeah, next week, 100% locked in. I'm still in the camp that they could skip December. It's a bit off. I think we've been a bit less pessimistic on some of the labor market risks than the Fed has. I shouldn't say the Fed, than the dovish kind of core than I would say Powell. We're probably more in line with the almost half of the committee that in September submitted dots that still showed a skip at one of the meetings in the remainder of 2025. So we're more on that side. I think, as we just discussed on the inflation side, we're a bit more worried about some of those inflation risks than I think Powell and probably his cohort on the committee are. And then, on the flip side, I do think the labor side, not as much to worry about, but we really need the official sector data to pick back up to actually see that delivered. If we're still in a position where we're not getting new official sector data on labor markets, I think it's going to be very hard to dispel a lot of those labor risks that I think got the Fed to cut in the first place. So that call for a skip in December and our expectation they pause in December is really contingent on getting that data resuming and seeing that labor markets are at least stabilizing, maybe even seeing a bit of a bounce in that data.
And can you see inflation dropping down to 2%, that goal of the Fed, anytime soon?
Well, the Fed actually pushed 2.0%. If you look at the median dot in the SEP from September, they don't have that happening until out to 2028 now. So there's a very wide berth around that 2% target. I think it's going to take us quite a long time to get back down to that level. And to your point, it's heading in the wrong direction. It's not moving south. It's moving higher, and we're cutting rates. So again, part of the reason I think we lean a little bit more hawkish than what we've seen from Powell and at least the the majority on the committee right now.
And what's the danger of it dragging along at 3%, staying up high like that?
Yeah, well, I mean, the concern of policymakers is always that as if you start to recenter, that expectation that there's kind of a self-fulfilling prophecy side of that if the market says, okay, instead of a 2.5% ceiling, the Fed's going to be okay running at 3, then inflation's expectations start to move up, and then so delivered inflation should theoretically start to move up as well. And then you just start this slide higher and higher where expectations and realized keep kind of chasing each other higher. So, I think the Fed certainly doesn't want the idea that a 3-handle inflation becomes ingrained in markets, and market participants, investors' minds, consumers' minds as acceptable or normal, which, again, this is why we do think the bar to pausing and the bar to stopping short of the neutral rate, the terminal rate that's been priced into market, that's why we are putting, I think, a decent probability on that.
Okay, we'll leave it there. Blake, thanks very much for joining us. Blake Gwinn is the head of U.S. rate strategy at RBC Capital Markets.